Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I am Arjun Patsarthi. In this podcast, we are going to continue from the September podcast where we talked about the shape of the yield curves. We talked about the current shape of the yield curve, which was flat to inverted with the short end rates equal to or even higher than the longer end rates. Now, today's podcast, we're going to talk about whether the yield curve will react to the RBI policy that was held yesterday, where the RBI said that they have changed the policy stance from removing accommodation to neutral. So, what does this mean for the yield curve, and what does this mean for the bond markets in general? So, what RBI effectively has said is that they are no longer in a tightening mode. So that means rate hikes are ruled out. And they have been in a tightening mode for at least about 2 years now. And with this change in stance going to neutral, what they have effectively done is set the stage for a rate cut going forward. Now, obviously, like a true central banker, the governor had said the risks are pretty high for inflation and other factors as well. But what they see is that the inflation is going towards their target, and their growth inflation dynamics are pretty okay at as far as they're concerned. And looking at the global central banks, which have turned accommodative, where the Fed, the ECB, and other developed nations have started to cut rates, RBI has changed its stance from a withdrawal of accommodation, again, I repeat, to a neutral stance. And this, again, I repeat, sets the stone for a rate cut going forward. So the current rate is at 6.5%. And maybe in the next 1 year, they could reduce the rates from here. What does it mean for the yield curve? Let us see. Now, where are the GSEC yields trading at? It's already almost all flat, slightly where the 5, 10, 15, 20, 30, 40, 50, all the bonds are trading in about 20 to 25 basis points, 20 to 25 basis points spread. So it's a very flat yield curve at this point of time. And the whole yield curve has shifted down over the last 1 year. So where rates were closer to 730 to 7.5 last year, it's come down to 675 to 7%. So clearly, there's been a good gain for all those investors who have invested in government bonds, especially the long-dated government bonds. So a 50 basis points fall in the 10-year government bond has given a return of for about over 10%. And for the 15 and 30-year bond, the returns are closer to 13, 14%. So investors have made very decent returns if they had seen this fall. And those of you who have been listening to Let's Talk Bonds over the last many years, we would have noticed that we have actually indicated that there is a strong potential for the yield curve to shift down at that point of time. So why are the long end rates falling down so fast in tandem with the short end rates? Largely because we are factoring in that the rate cuts will happen soon or in some period of time. Now, why are the short end rates staying high? Because RBI is still keeping the repo rate at 6.5%. And the cost of funds for the banking system is 6.5%. And by holding a treasury bill or a government bond below this rate doesn't make any sense because they'll be making loss. But if they invest in long dated bonds and the prices go up and as the yields come down, they make a good profit. So the market has been investing in the longer end of the yield. The question now investors and traders will have to ask is whether at 6.75% is a 10-year already factored in rate cuts, or is there room to go at least 25 to 50 basis points fall in the 10-year yield, and which would effectively factor in at least the repo rate at from 6.5% currently to 6% or below going forward. Now, but having said that, if the market is pretty confident that the rate cuts will happen, which is seen by the 5-year OIS interest rate swap, which is trading at closer to 6% levels, whereas a 1 year is trading at closer to 6.4% levels. So the 5-year is saying that definitely the overnight rates can come, repo rate can come down to 6% or below. Now, if this is the case, then obviously the cost of funds for the system will fall from 6.5% to 6%. And this would mean that with a lower cost of funds and with the longer end of the yield curve actually fallen sharply, the shorter end, which is the 5-year, 3 to 5 year kind of segment, can look a better proposition where banks can easily borrow at lower yields and and invest in shorter end bonds at higher yields and take that extra carry that you're getting on that, which is an easy way to profit while instead of taking a large risk on the longer end of the yield curve, where if for example if inflation starts to rise, then these price yields will rise and prices will fall sharply. But it's too soon to say. But the main thing here is that in the next 1 year, clearly RBI has set the stage for rate cuts, and this is looking positive for the shorter end of the yield curve. So this would effectively mean that till the rate cuts happen, the yield curve can actually look to shift down with and once the rate cut happens, the yield curve will start to steepen. So till the rate cut happens, the yield curve will continue to remain flat to inverted even, and but the outlook will be for the whole curve to shift down. But clearly, there are a lot of other obstacles going forward. The markets will have to watch out for those risks. So, given this, what is the outlook for other parts of the market, which is the credit markets? So clearly, one is that there will be more interest into 3 to 5 year corporate bonds, which is offering a decent spread over the JSEC. So anything from, say, for a AAA bond, even a 50 basis point spread will be a decent spread in the current market scenario. And investors will tend to load up more on these parts of the credit curve to take advantage of the expected fall in the repo rate. But going down the rating curve, which is the corporate bond below AAA, markets can be selective. RBI has also come and warned that some of there could be some risks in the NBFC sector, as they do see some NBFCs trying to go aggressively without commensurate risk metrics, and this they could believe could lead to some kind of systemic risk in the market, which they want to prevent. So now they have almost made it like a moral suasion. But if they believe that is continuing, they could come out with very strong measures going forward. Markets would have to be a little wary about the NBFCs that are not fundamentally strong, but looking to grow extremely fast. Having said that, there could always be good appetite for credits that are having a visibility of the next 1 to 2 years in terms of either a recent rating upgrade, which is improving fundamentals, or coming out with IPOs or equity IPOs, which could shore up their capital adequacy, or those who have received good amount of capital infusion, increasing their capital adequacy, and those who have managing to grow at a reasonable pace and maintain their fundamentals. So wherever there are good spreads available for good fundamentally strong lower rated bonds, then there would be a good appetite for that. So clearly there could be a dichotomy here where markets could clearly distinguish between a good credit and a bad credit. So that sums up the podcast today. Basically, summing up, giving us summarizing uh, the current shape of the yield curve, which is flat. That means the 5 and 10, 15, 30, all in a small range, can continue to stay, and yields can continue to fall across the curve till the our rate cut happen. And once the rate cut happens, then the 5 year yield, the 5 year and lower yields, maturity bonds can fall, yields can fall faster than the longer maturity bonds. And this would lead to a steepening of the yield curve. And given that there is a rate cut happening, there will be a good move into 3 to 5 year kind of bonds in the credit space, and selectively in the higher yielding space as well, depending on the fundamentals of the credit. Thank you very much for listening in. Do follow us on all podcast channels.